Now, if I were to put on my seller hat, everybody knows that valuation is not going to hold, including the investment banker. You're going to generate $2 billion in fees. That's a lot of money. You sit on the side of the table that most of my audience is trying to get to. That's kind of what you need actually out of a good investment banker. My younger self would hate what I'm about to say, but Eric, it's a pleasure to meet you. Pleasure to have you on the show. I know before getting started, you have a little bit of a disclaimer just to keep things compliant. So fire away and then we'll get started.
Thanks, Doug. Yep, the disclaimer is all expressions of opinion provided in this podcast are subject to change without notice and are not intended to be a forecast of future events or results. There is no assurance that the trends highlighted in this podcast will occur in the future or that the projections, if any, will be met.
Awesome. All right, now on to the fun. Eric, one of the things we like to do, we do more non-traditional openers rather than diving into the impressive resume. We'll get through that as we go to the show, but we want to start with something a little bit heavier hitting. And just, ironically, you sit on the side of the table that most of my audience is trying to get to. They're trying to get out, how do we sell the business? How do we start deploying capital, start buying businesses? So I'd like to start here. What does the average owner get completely wrong about a buyer like you that's actually thinking about when they walk into the room?
Yeah, I think the biggest thing that folks get wrong relative to private equity, and that I guess that's the thing I will start by saying. I work at a private equity firm as a partner and managing director. Interestingly enough, I have also done corporate M&A as well. And a lot of times people flip-flop those two of the expectations. So a lot of people, what they hear about private equity is that, private equity is going to come in, they're going to fire my whole management team, they're going to ruin my business, all those sorts of things. And private equity really doesn't want to come in and try to change a lot of things. Honestly, like the best situation for private equity usually is that they buy a really good business that has really strong cash flow and everything can stay as is and just improve the business or build on the business. So I think that's the biggest misnomer or stereotype that isn't true. Now there definitely have been some private equity bad actors in the world. Don't get me wrong, but what is interesting is like when I worked in corporate M&A, we were probably more likely to restructure businesses, especially from a human capital standpoint, just because there would be redundancies, and that's what corporate M&A calls synergies. So you don't need two CFOs, two CEOs, that sort of thing. But private equity usually wants to keep the management team intact, and usually is buying the business because it's a business that they like and they see steadiness as a good thing, not a bad thing.
You touched on something important in a lot of the myths, or I guess misnomers of people coming in, stripping it apart. How much do you credit that to, the same people that got it to where it's going versus where it needs to go is just an increase or a difference in talent versus not necessarily bad actors per se, but just how companies grow?
Yeah, that's a great question. I think that there are definitely you know, different CEO talents and or management team talents, right? Like just think about like the evolution that a business goes through, right? Like and it kind of looks like a bell curve usually. And stage one is, the startup phase, right? And in the startup phase, you really need a like product development sort of a CEO. And then, once the product's launched and it's going well, you need a kind of a growth focused CEO. And then, as the business matures, you need more of like a profit focused CEO. And then, a lot of businesses go through decline, and then you kind of need like a turnaround or profit improvement sort of a CEO. And then like the cycle kind of repeats itself. So, that's one, function of like what sort of CEO or management team do you need at the time. And then depending on what's going on, I tend to think if you think about like CEOs in terms of like functional expertise, they're kind of like, I think of it as like kind of three, right? So one is like maybe more of an operations focused person. Another one's more of a go-to-market sales and marketing focused person. And then another one is maybe more of a like financial and or like organization slash administration oriented person. So depending on like where you are in the business life cycle and like what sort of like functional skills you need, that will dictate, what your CEO or, top leader looks like, and then like what does the management team beneath them look like? And then it also plays a part into like if you're a, investor, do you and your firm have like the right skills to be investing in that kind of a deal, right? Because you hopefully ultimately, if somebody's like working with a private equity firm or a venture capital firm, they really should be picking somebody that's complementary to where the business is going to go. And ultimately, that I would argue to you that investor should bring more than just a checkbook. They should bring knowledge of the industry, and they should bring a Rolodex of other people in the industry, or people with skills that they can bring to the business to help the business succeed. So we do that at Speyside in what we call our human capital assessment framework. We look at, what are the things that need to happen in the business to create equity value, i.e., make the profitability and revenue go up, and then who are the people that have the skills to do that, and when do they need to be involved in the company or not involved in the company, and does that company have currently have the correct management team to be doing that?
When will you typically do that type of assessment if you're looking at a company, where in the due diligence
Mhm.
process, a level deeper, when's the right structure and ideal to structure to sell to somebody like Speyside? What does that company look like?
Yeah. Let me answer the last part first, and then I'll answer the due diligence question second. So for us, we're looking for 50 million to $500 million revenue businesses with 2 million to $100 million dollars of EBITDA. And we would most people would say we're in the middle market or the lower middle market, but that's what we're looking for is manufacturing businesses that we can improve somehow. Sometimes that's a fix and build where, if it's a business that needs to be improved operationally first, we'll do that, and then we'll grow it via acquisition and organic action. Or sometimes it's actually a business that's just fine, and it's just a just buy and build sort of a situation where we just want to improve it by growing the top line, not so much operationally. But those are the businesses we're looking for. 50 million to $500 million revenue manufacturing businesses. Those are perfect. We really love that place in the market. Just because with those businesses, they're big enough to have enough critical mass that you can do really interesting things with them, but they're small enough that you can do it quickly, right? There's not too much bureaucratic inertia working against you, to say it differently. So that's what we look for, and that's what we love, are those sorts of manufacturing businesses, generally in North America, although we'll do bolt-ons anywhere in the world. And in the past, we've also done platforms in Europe. But North American businesses, 50 million to 500 million in revenue is what we're looking for. Now, in terms of your question about like when do you start thinking about I guess the human capital and how it plays into things, I would tell you we start very early and often. Even like getting a teaser, we might even start thinking about it definitely when we have the SIM, which is the offering or information memorandum on the business, right? Usually 30 to 100 pages describing the whole business and how it's run. And then part of that, usually 2 to 3 pages of that will be, some sort of information on the org structure, who the management team is, what their backgrounds are, and things like that. So we're thinking about it as soon as we start getting that information. So that's a bit of a 30-foot or 30,000-foot view. And then as we go through, we like just getting, more and more and more granular and more information. And the reason why that's true is that human capital or people at the end of the day really, really, really matter. I mean, AI and robots haven't taken over everything yet. So people still do really, really matter. I think, in my humble opinion, I think people are always going to matter. We'll definitely, I'm sure 10 or 20 years from now, be using more robots and AI for things, but people will still be engaged. It just, the work will be a little bit different. So, and there's a lot of psychology that goes into that. And then there's a lot of like understanding, skill and will applied to a business and the human capital, and why the skill and the will of the people in the business make it such a better business. And in my opinion, usually that's like the biggest differentiating factor when you think about it in an industry. Like, if there's 10 competitors in an industry, why is there, 1 through 10? Why are they ranked 1 through 10? Usually what you're going to find is number one has really good human capital. And that's the differentiating factor, especially between number one and number 10, because great human capital builds great culture, and great culture builds great businesses with great equity value, in my opinion anyway.
Speaking of value, I know a lot of discounts can happen if there's a big founder dependency. What's your perspective on how that plays in, how you value companies, and how you kind of either transition founders, and what impacts that has on your offer?
Yeah, so a really good way to think about it is, or kind of a litmus test, I think that's an easy one to do and think about, is basically the question, answering the question, does the business have scalable, repeatable processes that are systematic, that are managed through people, other than just the CEO or the founder, right? So another like good, simple, pragmatic test would be, hey, could the CEO go on a 2 week or 3 week European vacation, lose their phone, be away from the business for that amount of time, and the business still progresses and gets things done? Now, maybe that be and I mean, like, basically it's business as usual, right? Now, we talk a lot about these businesses. Like, how much of the time does the CEO or owner spend working on the business versus in the business? And what I just described, if that person can go away for 3 weeks and the business will keep running, orders will, sales quotes will go out, new orders will be taken, new products will be manufactured and shipped and invoiced and all that. That tells me that, the CEO or owner is not working too much in the business. They're spending probably more of their time working on the business, thinking more about, like, where does that business go in the next 3 months, 6 months, 12 months, 24 months, 36 months. And that's a good thing, because basically the business can survive without that person. That doesn't mean they're not adding value. It just means they're spending more of their time working on the business versus in the business. And it's not a hub and spoke model where everything needs to run through that person for the business to function.
Now, you came up, I think, in your background, you were running plants, you've been managing union floors, like you've got a lot of background. What do you look for in a management team, that layer below that founder, to help assess the value and whether or not to buy a company or just discount the initial offer?
Yeah, yeah, great question. And I would say I could probably literally speak for months on that, but to try to boil it down into, maybe a few key items, I would say number one would be around, do they have the functional expertise associated with that particular function? So whether it's, operations like manufacturing and supply chain, or go to market and commercial in terms of sales and marketing, or, human resources, or finance, or, IT, or, whatever it happens to be, right? Do they actually understand their job at, like, kind of a, like, bottom to top perspective, right? And bottom to top matters because it's important that they understand how the work actually gets done. That's kind of more like the bottom part. But then the top part is, like, do they understand how fits into the overall strategy of the business. So, and then the top part is they need to understand how it fits into the value creation of the business, because the whole point of owning and running a business is to create equity value in the end. And they need to understand how their part of, that they're part of, like, fits into how it's going to affect the company being worth more, 1 year, 3 years, 5 years from now. So that's probably the first thing, and that's maybe more of like a hard skill, I guess, in a way. And then there's kind of like soft skill, right? They're like, emotional quotient sort of things, and understanding how to deal with people, and, do they have that knowledge and that savvy of, influencing without authority, motivating, things like that, whether it's, in managing all across the organization, up, down, sideways, inside, outside, et cetera. So those are kind of like, I guess I would say, the two big things, right? It's like, do you have the skill and will to understand the function that you're responsible for and how it fits into the overall picture? And then, like, secondarily, like, do you understand how to work with people in a team to get things done? Because once you get to a certain level, I mean, the reality of the matter is like, you're not going to just be in your own little silo, and you're going to spend a lot of time working with your other executives to, like, figure out how everybody's going to create equity value in the business based on, the 3 to 5 year vision, value creation vision, or the strat plan.
Now, you yourself, when you're talking about hard skills, soft skills, you have a pretty cool story about how you evolved into the space. Do you mind talking about your background and how it helps at Speyside and why you focus on manufacturing a little bit?
Yeah, sure. So yeah, my background, when I grew up in Detroit, or, well, in the Detroit area, and then I went to undergrad. And after undergrad, I came back to the Detroit area, and I was a consultant for several years. And I had kind of two or three, industries that I focused on. No big surprise. Being in the Detroit area, we have in the Midwest, we have a really big manufacturing base. So I don't know, probably like 80% of my clients were manufacturing. And I had, really cool experience from the perspective that I did some really, really big company engagements, like Ford Motor Company, and I did some really, really small company engagements, like companies nobody's ever heard of before, frankly. And even people in, like, the Detroit area, if I would have been like, oh, I was, working at Crudex, they'd be like, ah, who's that? What do they do? Never heard of them, right? But I really like that, like, seeing, like, the difference in, like, big versus small. And then I also did energy. So I worked with, like, a couple power utilities and some other things there, and then financial services. And what I found is, so I really love the most when first of all, I like my manufacturing clients the most. They were awesome. And then, honestly, the energy ones were my second favorite, because really they're just manufacturers of electrons for the most part, or, BTUs if they were a gas company or whatever, right? So it's like, I loved, like, tangible stuff was, like, my big thing. And what I found out is, like, my favorite parts of those clients was, like, going on the shop floor and finding out how things were made, or going and hearing how, like, sales forces executed selling and things like that. So I kind of figured out that I didn't love changing the world one PowerPoint slide at a time, as you do as a consultant. The intellectual challenge was awesome, but, like, the part that I didn't love was, like, you delivered the report at the end of the engagement, and then kind of you just, like, went away, right? And, like, I didn't want to just go away. I wanted to, like, stay and, like, do it. And that was kind of the epiphany, that I had, which is, like, I'm more of a hands-on kind of guy, right? I like tangible stuff that I can see and feel and touch. So I kind of said, all right, well, what do I want to do? And okay, then the other, like, kind of epiphany I had was, like, at these smaller companies, I did bunch of projects where, they were either doing acquisitions or integrating acquisitions, or looking at buying something or whatever, or selling their company or whatever. I'm like, wow, these guys in these smaller companies, like these CEOs and owners, like they're making a ton of money, like buying and selling these small businesses. Like that looks kind of cool, And so I kind of said to myself, all right, I either want to be a CEO or an investor in the manufacturing industry. And I kind of said to myself, all right, what do I need to do that? And the answer that I came to anyway was, if you're going to be good at that, either CEO or an investor, you really need to know how things work from like the bottom up, not just theoretically how things work, but like been there, done there, seen that sort of a thing. And I said, okay, how do I do that and prepare myself to be successful in that way by knowing, like really knowing how manufacturing businesses work? And I said, okay, well, I got to go back and get an MBA or a dual degree and use that to get experiences working in manufacturing companies, getting real experience, not just making PowerPoint slides. And then I can then parlay that into like a CEO role or an investor role. Ended up going back, getting my MBA, focused in operations, marketing, and strategy. And then I came out and I worked in a few different big manufacturing companies. And then ultimately, I became the CEO of a middle market manufacturing company that I sold off like 15 years ago. And then I've been working at Speyside as basically an investor ever since. And that's worked, really, really well. And I've loved it because my view of the world is like you should invest in what you know. And I know manufacturing really, really well. And it's not good enough to just buy things, I guess. Like private equity, I feel like that's something that private equity does get wrong a little bit, um, as an industry or as a culture, is that a lot of private equity firms, they think about like when they're buying a company, they think like close is completion, i.e., like, the deal closes, right? We bought the company, we're done, it's complete. It's not complete. Close is not completion, close is commencement. And as we all know, commencement means start, right? Because commencement is the start of the value creation process. You don't get paid just for buying a business. You get paid for making that business more over the 3 to 7 year hold period. So when you close and you buy a business, it's not completion, it's commencement of the value creation process. And having done a lot of the manufacturing jobs, that I've done, whether it's, working in supply chain, fixing a multi-billion-dollar supply chain, starting up and running a plant in Mexico, VP of sales, VP of marketing, corporate M&A and strategy, running a business as a CEO, and then touching all the ancillary functions while doing those things, it really helps me at what I do at Speyside because uh, close is not completion. It's just commencement to do the things we're going to do to create value in that business that I did in previous jobs, during the hold period.
I've seen a lot of ego around EBITDA multiples. People like, oh, I got 10x for this or 8x for this. Do you think some of that lack of focus, whereas you guys are really focused on manufacturing, you just have a lot of capital being deployed or people buying market share, is any, the silver tsunami or people getting to the game, they're just casting a broad net? How is all that relating to some of these insane multiples? And to be honest, most of them are just offers. I don't think a lot of those dealers are closing. But what's your just overall perspective, lay of the land, and how much that specialization is helping you versus where it may lack in the rest of the industry?
Yeah, great question. What you're starting to see in the industry is it's starting to become very bimodal, by AUM and focus or generalism. And so what you're tending to see now is basically the folks that are getting funds raised, they tend to be under a billion of AUM, or they tend to be greater than 10 billion of AUM. So there's small guys and there are big guys. And the small guys tend to be very, very focused on a very kind of, I don't even want to say niche, but like a dialed in strategy where they can go deploy it quickly and efficiently and effectively over and over again. Whereas the big guys, they're a little more generalist, but they have their weapon is scale. They're big. They can deploy a lot of capital very, very quickly. And they can deploy a lot of like experts and other human capital onto a bigger situation. And they oftentimes are hunting things where they're taking something public to private, or it's such a big deal that there's only so many people that can do it, sort of thing. And I would also argue there's kind of a mentality difference. I would argue that the smaller guys, we have more like the investor mindset. And then you have the bigger guys, they're more of a fund manager mindset. And that is a bit of a different mindset, right? So we as investors, we really focus more on getting rich off of building carry economics. So in private equity, there's kind of the typical economic model is called 2 and 20. So 2% management fee, 20% carry. 20% carry is paid based on the deal profit. So investors carry or care more about the carry because like there's a lot of 20% of a deal profit matters. That's what investors do. Fund managers care a little bit more about like the size of their fund because 2% of a large number is a lot of money. I mean, if you're a $10 billion fund and you get 2% every year off of 10 billion for 10 years, well, 2% times 10 billion is $200 million times 10 years. It's $2 billion, right? You're going to generate 2 billion in fees. That's a lot of money. Now it's not, it goes to pay, theoretically, it's supposed to go to pay for all the people working at the fund, but there's economies of scale in private equity as well. So if you're really big and you have more AUM, you do pretty well off of the fees, right? And if you're like some of these supersized funds that are like 50 billion or 100 billion, I mean, if you're a 100 billion AUM fund, you're getting literally 2 billion in fees a year. I mean, that's crazy to think about. So anyway, that's a little bit of the difference, I would say, in what's going on in the world. And those folks in the middle are starting to they're getting pushed to one end or the other, either be a smaller focused fund or be a larger, economies of scale fund. And what that's helping with, I would argue a little bit, is I think it's bringing valuations a little bit more in line because there aren't as many people chasing less deals.
I love that. Now, if I were to put on my seller hat, most of these sellers, they probably, let's just say they've been at 20, 30 years. They built a really big, decent company, especially in the manufacturing space. Most of them probably are not exposed to private equity, like you mentioned. What are things they need or should start to understand when they're picking a partner that they're going to choose to sell to? And then we'll follow up with some multiples and things they should do. But how do they even start the conversation?
Yeah, the first thing I would say, what I tell everybody who asks me about this is like start early and often. Like the selling process it's longer than you expect. And if you think you want to sell a business, kind of, pencil out 18 to 24 months to get to a close from the time you start to prepare the business for sale to actual close. That's number one. Number two, and my younger self would hate what I'm about to say, but I've gotten wisdom over the years. But pick a good advisor, like pick a good investment banker, because I will tell you, like good investment bankers and advisors are actually kind of worth their weight in gold for both sides. And what I would tell people is like the reason why that's true is because for two reasons. One's quantitative, one's qualitative. The quantitative reason is investment bankers tend to have a lot of knowledge and information about what's going on in the market. And so they can be very realistic, oftentimes, about, or the good ones are very good about explaining to sellers what to expect in terms of valuation, what gets paid for, what doesn't, et cetera. The qualitative aspect of an investment banker, I like to make fun of my investment banker friends, and I tell them all the time that they're not loyal to the seller or loyal to the buyer. They're just loyal to the deal. Um, and that's okay. That's kind of what you need actually out of a good investment banker. Here's why that's valuable qualitatively. They're also like a great like conflict counselor, or you know, um, or maybe a marriage counselor. I don't know. I've been married 28 years. I've never been to marriage counseling, but like the reality of the matter is like during a deal, you're going to start like at an LOI, and you and the buyer and the seller are going to be on the same page. And then as due diligence goes, there are going to be times where like you go off the page, and a good investment banker brings you back together, right? They mediate conflict, right, over time, and then they get eventually, because they're loyal to the deal, they get you to the close, right? And that's what the good ones do. They're pretty like neutral, and they find common ground for both parties to get a deal done. But having a good one of them is they're invaluable. Like, and some of these sellers will look at it and go, "What does an investment banker really do?" And honestly, it's like one of those things. It's like the mechanic that's been doing mechanic work for 30 years, and you're like, why do I pay this guy 2 grand? It only took him like 30 minutes. Well, if you went to the guy who just got out of school, it would have taken him 3 weeks. So you're paying the guy for their knowledge and like expertise in terms of and judgment. Like that's why they get paid, and they're worth every penny when they do it well. So those would be the
Wisdom is
two big things. What's that?
wisdom is worth so much.
Yeah. So those would be the two big things. Start early and hire a good advisor. I mean, there's tons of other things I could say, but if you ask me for the two biggest pieces of advice would be that. And maybe a third one would just be like, if you're selling to somebody who's not like another like family or like owner operator, if they're a professional investor or buyer of businesses, either they're in corporate M&A or they're in private equity or some sort of fund, just don't be upset about the fact that like we in those groups tend to be dispassionate third parties. It's not that we're callous or don't understand or sociopathic or something. And we do have feelings, but like we look at so many businesses, it's like you just kind of get immune to, sometimes you forget that like somebody selling a business, it might be their first or second or even third time, and you've done it 100, and so it's like it's not new to you, and so you sometimes you forget about the emotions that go into it. But that doesn't mean they shouldn't be a good partner, and they shouldn't listen, and shouldn't try to understand what the seller's trying to achieve with the sale. I'm not saying they shouldn't do that. I'm just saying cut us a little bit of slack. We do this 80 hours a week for decades, and you know it's not as new to us as it is to others. So sometimes we forget that it's new to people.
I don't hold it against you. We see a lot of deals that come through, and there's as many stories of like deals going sideways at that last minute, emotion gets hot. Do you have any stories, from the deals that you've done that stuck out as like, hey, here's how to manage those really tough times when it's emotionally charged to work through to the finish line?
Yeah, I think so in my opinion, and there's a big reason why I do this, which is I think being direct, open, and honest from the start is really, really valuable. Um, so like I tend to be like with, as a buyer with sellers, just kind of tell them, hey, look, this is why we're interested in buying your business. This is how we're thinking about it. These are things we can do. These are things we can't do. And then, I've found if you're direct, upfront, open and honest about things, like, and explain why. and people, and as a result, like, and you're not trying to jerk people around, like they understand what you're trying to achieve and why you're trying to achieve it. And that, I guess that works for us at Speyside. It also sometimes honestly works against us from the perspective that, to your point, I see this a lot where people will, in these processes, other firms or other buyers will throw out these ridiculous valuations. And it's like everybody knows that that valuation is not going to hold, including the investment banker, right? And this is why hiring a good investment banker is really valuable, because a lot of the bad ones will tell sellers they can get them like a 10x multiple or something crazy on their business. And then when all the offers come in, they're usually, frankly, 20 to 30% less than that. And then the seller goes, wait a second, you told me I was going to get 10 times the EBITDA. Why is it now 6 or 7 times the EBITDA? And then what the bad banker does is they of course have a Rolodex of excuses, because the guys that are MDs at investment banks have been doing it for also 20 or 30 years. And the Rolodex of excuses that they have are things that they can point to of why the business isn't worth as much that aren't their fault. And the best excuses they love the most are ones that aren't their fault and it's not the seller's fault. But if they have to choose between like it's their fault and the seller's fault, they're going to pick it's the seller's fault. And also, like, buyer's fault is great too, right? Because then it looks like the valuation that they use to get the gig isn't as terrible as what it turns out to be, right? But I think that's important, to understand and like kind of know what you're dealing with. There's a famous book called Liar's Poker that was written, and it's about an LBO deal. But if you've ever played actual real Liar's Poker, that's a lot of like kind of what's going on in getting a deal done. It's like, the buyer has a dollar bill, the seller has a dollar bill, the investment banker has a dollar bill, the debt lender has a dollar bill, and we're all, you know, trying to get to 10 aces, right? And win the pot. And it is a bit of a game of liar's poker at the end of the day.
That's awesome. Now, before we wrap up, is there anything you look back over this journey that if you could go back and give, one piece of advice, during those like hardest times, what would you go back and tell yourself when you started this journey that would have accelerated to where you are today?
Yeah, find some patience earlier. And it just, I mean, these things are all a process. And um, patience is, I, patience is a virtue, and it's probably one of the most valuable virtues or characteristics you can have in this game, because it allows you to be, disciplined and get good deals done. And again, like, back to where we kind of started the conversation, like it's a people business, and like we're all humans, we're all need puzzles, right? And like you got to understand that, like, and you should know the person who's across from you, either the buyer or the seller. By the end of the process, you should probably kind of know that person much, much better than when you started, right? Because you're gonna spend a lot of time interacting with them, and that's helpful, getting to know them, if you can, because it helps you find common ground, and it also helps you find patience.
That's great. This was a ton of fun today. And as we wrap, especially for our manufacturer looking to sell in your range, what is the best way for them to learn about you, find your business, and if they have a right deal, send one your way?
Yep, you can find me, my contact information, either on our website, spaceidequity.com, or if you go to my LinkedIn profile, you can find my cell phone number and email address in there as well. And yeah, happy to chat with people if they're looking to sell a manufacturing business, 50 million to 500 million in revenue. We do all kinds of deals, easy ones, hard ones, well-run businesses, not as well-run businesses. So give us a call. We're happy to chat with you, and we're always looking to buy good businesses.
Awesome. We'll make sure to put all of those in the show notes so they're easy to find for you. Eric, thank you so much for joining us today. This was awesome.
Thanks, Doug. Thanks for having me.